Homeownership comes with plenty of challenges, like taking responsibility for the overflowing toilet at 2 o'clock in the morning and keeping your trees well pruned so a storm doesn't result in damage from a limb crashing through your neighbor's roof. There are plenty of advantages too. Over time, well-maintained real estate property usually increases in value, giving owners a healthy return on investment you can use to buy a larger home or borrow against for other needs or wants. Understanding the tax and investment aspects of homeownership will position buyers to capture all the benefits of homeownership available immediately and in the future. As a real estate professional, you can guide first-time and experienced buyers towards wise investments by staying informed about changes in local, state, and federal tax codes, new building regulations, and neighborhood amenities for every lifestyle. In this lesson, we'll discuss some of the tax and investment aspects of homeownership every real estate agent needs to understand to become an advocate for both sellers and buyers. Taxes are always on the minds of first-time buyers, so let's begin there. The tax code is like a lazy river meandering downstream. On the surface, it looks like nothing really changes as the water moves along. But beneath the surface, there are hidden hazards and treasures. Staying up to date on federal tax code changes ensures you never miss one of those beautiful treasures or trip over a hazard by claiming deductions that you aren't eligible for based on the type or use of your real estate. Before we get into some examples of how homeowners can leverage tax deductions to reduce the costs of homeownership, let's take a look at a few important finance terms. First-time homebuyers often don't recognize or understand industry jargon. Many are embarrassed to ask questions. 4 words that usually show up in every initial mortgage conversation are mortgage interest, discount points, loan origination fees, and private mortgage insurance, or PMI. These terms may come up when talking to clients about pre-qualifying and the true cost of financing before making any offers. You probably already know that mortgage interest is the fee lenders charge to offer loans secured by either a primary or secondary home, used primarily for personal use. This fee is structured much like a revolving loan. Interest is calculated every month or after every scheduled payment on the remaining principal over the term of the mortgage. Loan origination fees are a bit more complex. Lenders charge administrative fees for reviewing applications, verifying credit worthiness, and processing paperwork prior to issuing a loan. The fee is based on the price of the real estate and typically equals 1% of the loan value. The origination fees cover the lender's costs for funding the loan. One term you will constantly come upon is points. What you have to remember is that 1 point is equal to 1%. So if you hear someone saying 3 points, they mean 3%. You will also hear the term buy down, which is commonly used when buyers are looking to get discounted rates at least for the first years of their mortgage. Discount points allow buyers to prepay interest in exchange for a reduced mortgage interest rate. You may opt to pay 0 points or go as high as 4 points in some circumstances. As a rule of thumb, you can figure each point will cost about 1% of the loan amount. So, a 1-point buy-down on a $90,000 mortgage equals $900, which is in essence 1% of the mortgage amount. 2 points equals $1,800, 3 points equals $2,700, and so on. There are some conditions that govern the buy-down. For example, Homeowners must utilize the cash accounting method when preparing tax returns to claim deductions. Most people do anyway. And the size of the buy-down must be customary for the neighborhood. A word of caution before we move on to the last term on our list. There are many types of points discussed during the mortgage application and funding stages. While discount points and loan origination fees are tax-deductible, origination points are not. Some lenders tack on hidden fees under the label of origination points. If you ask for an itemized point statement, you may see charges for property inspections, a title search, lawyer fees, notary public services, and other add-ons, all of which are not tax-deductible items. Just because you can't take an immediate deduction for origination points, it doesn't mean you should ignore them. Clients considering investing in rental property should know that discount points and origination points qualify as depreciation expenses and can be amortized, along with certain other expenses of buying, building, or improving real estate holdings over the life of the real property. Private mortgage insurance, often referred to simply as PMI, is protection for the lender if a buyer fails to make payments. This insurance premium is typically included in the total monthly mortgage payment. However, a one-time payment may be made at closing. Some lenders allow a large PMI down payment and smaller monthly installments as part of the regular mortgage schedule. PMI may be dropped after the balance falls below a predetermined amount because this type of coverage is usually only required on conventional loans with a down payment less than 20%. Or if the buyer wants to refinance a home with less than 20% equity built up. Okay, now that you know some common mortgage terms, let's talk about the federal tax benefits of owning real estate. Homeowners who file a 1040 and itemized deductions on Schedule A can usually deduct mortgage interest paid, discount points, some real estate taxes, origination fees, and PMI associated with first mortgages, second mortgages, equity loans, and lines of credit secured by your primary residence or a second home. Let's go over a few of the most common deduction scenarios. Homeowners may deduct mortgage interest paid on a debt secured by a primary or secondary home, wholly or partially owned. That simply means you can own 100% of the real estate or share ownership with one or more people. The Internal Revenue Service considers any real property that has sleeping, cooking, and bathroom facilities a qualified home. So, along with accessing tax benefits for traditional homes like condos, trailer houses, and single-family residences, if you live in a mortgaged houseboat, recreation vehicle, or other structure that fits the description above, you can deduct interest paid as long as you use the property solely for your own personal use, with a few exceptions. Commercial and rental properties fall under different umbrellas in the tax code. We'll briefly talk about those items later. Here are 3 examples that demonstrate how ownership percentages and use rules affect deduction allowances. In the first scenario, let's say Jeffrey fully owns his residence and occupies that home all year long. Each year, his lender provides a 1098 form detailing the total interest, discount points, and PMI paid in the previous year. If the 1098 form shows Jeffrey paid $2,000 and that amount is less than the value of his home, he can usually deduct the full amount. But what if Jeffrey shares an ownership interest? For this example, let's say Jeffrey shares ownership equitably with 4 other people. Based on the details in the previous example, where the annual 1098 statement reflects $2,000 in payments, Jeffrey can only deduct $400, which is the total divided equally among the 5 owners. It is possible to structure ownership with different ownership percentages based on the original purchase contract, or the amount each buyer invests in the purchase and/or property improvements. For example, Jeffrey could own 60%, and each of the other 4 owners own a 10% share. Now, imagine that Jeffrey owns 100% interest in his home and wants to rent out a couple of rooms to earn some extra money or defray costs of ownership. As long as he does not lease any part of his home for purposes other than residential living, and the leased space is not self-contained, meaning it cannot be construed as a complete home unit with separate cooking facilities, bathroom, and sleeping quarters, Jeffrey can treat the rented space as part of his personal home for tax purposes and claim the full tax benefits based on 1098 figures. One caveat: he is not allowed to lease the same space or different parts of his house to more than 2 renters at any time during the tax year. There are dozens of other special rules and exceptions within the tax code that directly and indirectly benefit homeowners. IRS Publications 936, 17, 550, and 530 provide general information worth reading if you find yourself wanting to become more proficient in ways that could help homeowners. That is not to say that you should give any accounting advice, though. Leave that to the trained professionals. Before we leave tax benefits, turn your attention to real estate taxes for a few minutes. Real estate taxes are a tax-deductible item. Real estate tax rates vary widely by state, town, and even neighborhoods and communities within cities. Each appraisal district offers a diverse set of discounts and exemptions, including adjustments for people over 65, disabled veterans, and non-veteran disabled persons. Fortunately, homeowners can contest the assessed value and participate in open discussions during the proposed assessment phase. All tax assessments are based on market value and differ according to the benefiting entity. As an example, a combined tax statement for a rural town in Texas assessed a county tax at 0.0457330, a city tax at 0.0735200, a local independent school district at 1.30804000, the junior college at 0.366350, and the regional water district at a rate of 0.008026, for a total annual tax of $494.60 on a property with a market value of $17,200. You may not deduct special fees that only apply to individual homeowners within a tax district, such as late fees, interest on unpaid tax bills, and water connection fees, or financed meter upgrades. All allowable taxes must meet a conformity standard, which means that all real estate owners in a common district or community are billed for the same entities at the same rate. We have focused heavily on tax deductions and first-time homeowners so far in this lesson. However, as you work to grow and cultivate your farm, you may work with commercial buyers, people looking to sell their homes, and investors. For those of you who aren't familiar with the phrase cultivate your farm, successful real estate professionals sometimes pick a particular subdivision or section within a county and proactively plant seeds they hope will help them generate future sales. They take the time to get to know the residents, find out what they like and don't like about their homes, and maintain contact with these people, hoping when it comes time to buy or sell, they will call them first. Part of farming an area means you have the knowledge and resources to serve the community. So, let's talk about capital gains for a few minutes and shift our focus to sellers. Capital gain is the effective profit or loss realized based on the difference between the sale price of a piece of real estate and the cost of acquiring the asset. We mentioned earlier that origination points aren't deductible expenses. However, when it comes time to sell a property, the net profit reflects adjustments for transaction fees, such as real estate agent commissions, attorney's fees, and sales tax, among other expenses. There are short-term capital gains and long-term capital gains. Real estate investments purchased and sold within a one-year period have higher tax rates than assets held longer than 12 months. The current tax rate is based on marital status, tax brackets, and how the property was acquired. The sale of a property does not push a taxpayer into another tax bracket. For almost 2 decades, the short-term rate has remained the same as ordinary income. However, long-term capital gains have fluctuated significantly, with a maximum effective tax rate as high as 40% in the mid-1970s. The effective tax rate for long-term holdings ranges from 0 to 20% for most homeowners. However, the maximum rate currently includes an additional 3.8% added to the capital gains bracket for the top earners in the United States, making the highest tax rate 23.8%. Top earners are classified as a single taxpayer that earns more than $200,000 per year, or a married couple filing jointly who earns more than $250,000 per year. But what about accidental homeowners? An accidental homeowner is someone who inherits a piece of real estate and decides to make the property their primary residence. Fortunately, immediately after they legally acquire the property, the cost is bumped up to fair market value, which means they do not have to pay capital gains tax on appreciation realized during the previous tenancy, or face a huge tax burden when the property value is worth much higher than the original cost. In some instances, homeowners may be required to recapture depreciation when a piece of real estate is disposed of. This is primarily called into play when the sale price exceeds the cost, which brings us to a discussion about depreciation. Tax depreciation is a gradual reduction in the value of your property that allows you to recover part of your cost or other basis in the form of a tax adjustment. You cannot depreciate land. However, you can depreciate structures and improvements, including rental property. The most common depreciation method is known as the Straightline Method, where you divide the value of your house by 27.5 to get the allowable annual depreciation deduction. So, assuming you have a rental home valued at $150,000, your annual deduction for residential property would be $5,454.54, which is the result of dividing $150,000 by 27.5. Non-residential, commercial real estate is assumed to have a lifespan of either 39 or 40 years, depending on whether you use the General Depreciation System, GDS, or the Alternative Depreciation System, ADS, to calculate annual loss in value based on wear and tear, damage, and obsolescence. You calculate straight-line depreciation by dividing the difference in the salvage value and the purchase price, or cost to build the structures, by either 39 or 40. Land is not depreciated. For now, let's leave ways to save money and move on to ways to make money and really capture the positive benefits of real estate investment activities. From an investment perspective, taxes are not the only thing to consider when buying and selling real estate, maybe not even the most important consideration. A well-informed real estate agent understands the importance of building equity and exploiting appreciation as the market changes. For example, single-family home values usually change based on market statistics, also called stats, and comparisons, also called comps. As transactions in a neighborhood generate higher sales prices based on normal inflation as a response to the economy or fluctuation in demand, property values increase for similar homes. In multifamily environments, some investors proactively force the appraisal value to rise by adding upgrades and amenity packages that boost revenue potential, then gradually increase base rents, which makes their properties more attractive to potential buyers. Forcing appreciation doesn't work as well for personal homes as it does for apartments and planned communities. Over-renovating a home in a modest neighborhood won't necessarily bring higher returns unless other homeowners follow suit. Most homebuyers who invest in a personal residence are more interested in growing their equity faster to allow them to access available money for renovations or as a down payment on another home. Buying low is the best way to grow an equity nest egg. Here's why. On a typical 30-year fixed-rate mortgage, it takes approximately 22 years to pay down half of the original loan principal. The first few years, the majority of each monthly payment goes to pay down the interest on the loan. Over the full term of the loan, a buyer with a $165,000 mortgage financed at 4.5% will pay a staggering $300,970. That's $135,970 in interest alone. More than 45% of total payments cover only interest. It may not be a good idea to show potential buyers how much they will ultimately pay for a home if they plan to make payments that long, unless you plan to show them how they can save money by doubling up on their payments or paying a little extra each month designated for reducing the principal. That shows them they have control over how quickly their equity builds up. We've covered a lot in this lesson. The last section covers the starker exchanges, also known as like-kind or 1031 exchanges. If waiting impatiently for equity to grow or trying to force faster appreciation doesn't work for your real estate clients, you may introduce them to exchanges as an investment tool. Are you wondering what a 1031 exchange looks like? Here's a brief overview. The IRS code allows two property owners to literally trade like-kind property without paying capital gains taxes. There are a few requirements that must be met for property owners to defer or avoid tax liability. For one thing, these exchanges only apply to business and investment properties. You can't trade a private residence for another private residence. And you can't exchange a piece of rental property for a moving van or construction crane, even if they are valued at the same price. You could trade a 4-unit apartment home for a single-family rental as long as the exchange results in the net market value and the property equity purchased is the same or greater than the property you're selling. You can also apply reasonable acquisition expenses to the cost of the new property. Here's an example of what it would look like. Say you have a multifamily apartment building valued at $1.5 million and a mortgage of $400,000. And you want to work an exchange to avoid paying any capital gains tax. You could purchase a single-family home or several properties that have a combined market value of at least $1.5 million. And you would need to carry over a minimum of $400,000 in mortgage liability. It isn't as easy as simply transferring the deeds, although that is allowed, because finding another business property owner with a similar valued property as yours who is looking for a quick swap would be like finding a specific grain of sand in the middle of the Sahara Desert. Usually, an investor first sells a property and then reinvests the proceeds in a property with a similar cash value and functionality, equipment for equipment, structures for structures, etc. Often, investors involve a third party to act as a middleman or open an LLC so their business can hold the assets in escrow until a suitable swap can be found. There are other options, but these are the most popular. This strategy works very well for investors who are looking to change the type of business real estate they own. For example, a property owner may want to trade an assisted living property for seniors for a high-rise that caters to college students. Or a management company may be looking to expand single-family homes and move away from multifamily complexes. Sometimes, companies want to invest in another area, so they look to real estate in other towns or states to complete a like-kind exchange. One last thing to consider with 1031 exchange transactions. Buyers have several timing limitations. For example, the property seller only has 45 days to identify up to 3 potential properties that would qualify as like-kind properties. It is possible to swap 4 or more properties, providing the combined total does not add up to more than 200% of the real estate being sold. And all transactions must be completed within 6 months, or 180 calendar days of the first closing, unless the property owner files for a tax extension. We've only touched on the 1031 tax-deferred exchange options. It is quite entertaining to read through examples of how investors put their creative spirit to work negotiating deals. It is a high-stakes game for some people to see if they can find similar properties in areas they want and get all their I's dotted and T's crossed in time to avoid paying capital gains taxes. You have a responsibility as a real estate agent or broker to learn as much as you can about helping your clients make wise decisions as they buy and sell in the marketplace. Armed with the topics covered in this session, you can better help your customers understand the tax and investment aspects of home ownership.